Good morning. This is Jovine from Behind the Markets. Happy Friday, TGIF. Today is December 20th. Woof! And we are here. I'll tell you something. I didn't realize this, but the stock market had gone down 10, 11 days in a row, which is the longest losing streak since 1974. Isn't that something? That is very interesting to me. And I did not know that. And then, of course, on Wednesday, the market was down 1,000 points after the Fed lowered rates by a quarter point, which was a mistake in my view. Look, what's happening to the stock market? It looks like the stock market is actually catching up to what the bond market's been saying. The Fed started lowering rates in September, and I just have some notes here. The Fed lowered rates by 100 basis points, a full percentage point, and the 10-year Treasury yield, which is the Treasury yield by most people use to compare their stock investments is up 80 basis points. So the Treasury yield is ignoring the stock market. The bond market basically is ignoring the Fed and the stock market. And this is a weird, unique situation, frankly, in American history. And basically, what you have happening here is bond investors are saying, it doesn't matter what the Fed does. Okay, forget the Fed. The Fed's out of control of the bond market beyond a couple of years, maybe 5 years. Basically, anything outside of that, we're not listening to the Fed. It used to be the Fed would lower rates, and then all types of long rates would go down, like mortgage rates, 30-year bond rates. And remember, mortgage rates are based on 30-year bond rates. So the Fed would lower rates, then all of a sudden, all these long rates at 30 years and 20 years and 10 years would go down. But the opposite is happening now because professional investors are saying what we've been talking about here for a long time. No way am I going to accept 4.5% interest for 30 years. No way. The bond investors, the most sophisticated investors, frankly, because the bond market is literally dwarfs the size of the stock market. But the bond market is saying, look, too much inflation, too many deficits, the tariffs is crazy. And now you're going to do more tax cuts? You're going to run so much red ink through this country that for us to lend you money for 30 years, you have to pay us a heck of a lot more, buddy. You got to pay us a heck of a lot more because you're going to debase the currency. We're going to hold bonds, and the value of those bonds is going to go down every year. The more red ink, the more deficits, the more fiscal irresponsibility there is. So the market going down doesn't surprise me on that. And can't even believe the Fed even lowered rates here. It seems to me a little bit surprising. But remember something. There's an inverse relationship, a seesaw relationship between interest rates and the stock market. Rates go up, stock market goes down. Rates go down, stock market goes up. Now, of course, the rates did go down yesterday, and the stock market went down also because of future expectations. The Fed said, whoa, they got a lot more hawkish. They said, we're not going to cut 4 times next year, another 1 full percentage point. We might cut 2 times, maybe. So they really backed away. So investors said, gosh, this kind of looks like maybe the end of the loosening cycle. And again, I think that what's really interesting to me is, again, I started off with, this is the longest losing streak for the Dow since 1974. And this is a very different Dow. There's a lot of companies. This is a Dow that's being manipulated greatly. Any stock that's not doing well, they get rid of it and they just replace it with stocks that are doing well. It's a rigged Dow industrial average. It's crazy because there's only 30 stocks, so you can rig that really easy. S&P 500 is harder to rig because there's 500. You can rig that too, to a degree. But what they do, the wise people that run the Dow, is they've really just put well-performing stocks in there. This compares to 1974 when it was really just a better representation of all sectors of the economy, good and bad. Basically, what's happening here is this is the longest losing streak in so many years. In 50 years. 50 years. What is that telling us? I think it's telling us everything that we've been talking about here for a while. This stock market became unhinged, disconnected from reality in the middle of the year, July, August. It has just been even crazier since then. And professional investors, bond investors, where the big money is, the people who determine the stock market, it looks like the stock market may finally be catching up to some reality here. But again, a group of birds can fly in any direction it wants for as long as it wants. We really can't predict that. All we can say is the market's overvalued by any stretch of the imagination anybody wants to use. And this is the nature of the things. The stock market has a historic down week. Not 50 years has the market had this bad of a week. And it looks like they're finally listening to the bond market, which is where we spend a lot of time with our attention. Anyway, have a great weekend. I'll see you Monday.